let's talk about interest rates a little bit. They're hovering still, between 6.9 if you're a first-time home buyer, 7.3. These are no-point cost. This is 20% down, good credit. 6.9 if you're a first-time again, 7.3 if you're not. There's some resistance out there that's developing in the market to lower rates right now. Now, I don't think it's got long-term resistance, but inflation is coming under control. The core is still higher than the target, in the Fed's target, but it's improving. And you would expect this to result in lower rates, but the economy is resilient. We're still seeing some strength in the economy. And so the Fed doesn't have as much pressure to lower rates as they would if their measures were obviously creating a recession, which is what everybody kind of anticipated. People have been anticipating a recession since the Fed began this, and that was thought to be the Fed's if unstated explicit goal. But the jobs market especially is still strong, with job openings still in the high 9 millions right now. The Fed looking for closer to around 7 million. And so we've got a little ways to go before the strength of the job market abates somewhat. And I'm really setting myself up for a big fail here, because here we are at the first week of the month, and always the first Friday of the month is when the jobs report, the non-farm payroll report, comes out, and that's always the single most potentially influential economic report, domestic report that gets released. Apart from all of the other kind of global events that can affect interest rates, wars and economic tensions and all of that sort of thing. All of those things can have impact on interest rates. But really the thing that happens every month is the non-farm payroll report. And that has always been the most influential report in terms of domestic, predictable economic reports. And so the market's always watching this. And then with the Fed's focus on jobs recently, that's only increased. There's even more focus on that. So we have the big monthly jobs report coming out on this Friday, first Friday of the month. And this podcast will probably drop just in time for me to look foolish with my predictions here, but I'm gonna talk about it anyway. Economists are expecting about 400,000 jobs created across the nation. And the good news is that the market is already expecting a strong jobs report. That's a strong expectation, 400,000 jobs creation. And so the market is already expecting a strong jobs report, and that's already baked into the pricing. The market's always pricing in what it expects to happen, not what already happened. What already happened is past news. What is moving price now is what they expect to happen in the future. And of course, the jobs report on Friday could still surprise on the upside, but less risk of that happening than if a weak report was expected. So I do think that's good. We did see the total job openings miss a little bit. It was slightly weaker than expected this week when it came out in the high 9 millions. It was only off by really a small fraction, but that's better than being on the upside in terms of interest rate influence. And so again, that expectation of a strong jobs report is already baked into the report. So maybe that glimmer of the job openings report that came out earlier the week, that came in a little weaker, maybe if we see a weaker than 400,000, which could still be a strong jobs report. You could get a $300,000 jobs report. That would still be considered a relatively strong job creation, but it's 100,000 less than what is expected, and that would move markets and move rates in a lower direction. I believe that would happen. Now, all of these things are subject to whatever happens next. And that's kind of the big takeaway right now in the market is the market's still very sensitive, very reactionary. We still have some level of volatility based upon whatever the latest report is coming out. Now, all this said, the largest mortgage lender in the United States right now, United Wholesale Mortgage, they're hiring in anticipation of a refi boom. They really do expect rates to come down, and that feeling is shared very widely. Where people differ primarily is on how long it's going to take before those rates come down. But I think if you asked how many people expected within a year for rates to be meaningfully lower than they were today, I think you'd see a fairly wide margin of people who are in favor of that.